Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the MarketSite in Times Square, we have Rob Farrington. He's the managing director of asset management over at Abbot Downing. We're going to take a look at where risk meets return. Rob, it's great to have you back with us at MarketSite. And this was one of those weeks where you really want to put that into perspective.
Yeah, there's no shortage of things out there that are causing the markets to snap around a little bit. And, light trading activity, not a ton of coverage with people on vacation. That tends to exacerbate some of these intraday moves.
All right, now the consumer has really been in the headlines with retail earnings over the past couple of weeks. It seems as if consumers are confident, but businesses not so much when you take a look at forward guidance.
Yeah, we call it a tale of two markets, and it really is important. So you've got the businesses on one side, they're pumping the brakes a little bit on things like R&D, advertising, CapEx spending. The flip side to that, though, is if they're not spending, then they're building up cash piles. That's not necessarily a bad thing when some of that CapEx starts to slow down in the face of uncertainty. And on the other side, you have consumers who have always been the most important component of GDP. They're anywhere from 65 to 70% of GDP, depending on when you count it. And things for the consumer really couldn't be much better. They've got great job prospects. That's something that hasn't been here during the entire recovery. They've seen 3 straight years of kind of 4 to 5% wage growth. Debt service is low. They're even getting a break with oil prices moderating a little bit. So we're really deferring back to the strength of the consumer when we try to sort of sift through the noise of some of this intraday stuff.
I think part of the problem, though, fiscal policy is largely non-existent. It's very erratic in terms of what's happening with global trade. That has to give businesses some pause as well.
It does, and I think it's probably not going to get resolved or come any tighter into focus in between now and the next election. Maybe there's a chance if there were a 10 to 15% market sell-off or the macro data started to really soften up, that Washington would be able to kind of reach both across the aisle and come up with some sort of fiscal plan, because there is room to take activity there. But if we stay sort of flat to moderately higher in terms of markets, there's not a whole lot that we think is going to get done between now and the next election cycle.
All right, so when we talk about where risk meets return, how are you approaching asset allocation in markets that have, quite frankly, been as choppy as we've seen in a long time?
Yeah, I think the most important thing, and it's one of the first steps that we always undertake with clients, is build an investment policy statement. That becomes the foundation of the entire asset management relationship. That establishes asset allocation targets and ranges. It establishes a reasonable expectation about spending in and out of the portfolio. It clearly delineates who's responsible for which components of the process. And so on days like today, weeks like these past few weeks, that asset allocation plan that was established at the beginning becomes critical, because it always gives you the place to come back and say, okay, at the end of the day, if we sold off 2.5%, 3%, where does that leave us relative to targets? Are we in a position where we think it's advantageous to rebalance back to targets? So we think it's a good kind of anchor to windward.
All right, now the ultra high net worth investor, how are they approaching these types of markets? Where are they looking to get some alpha in, where equities and bonds are just really erratic right now?
Yeah, I think one of the biggest things that always tends to drive the decisions that we're making on behalf of our clients and that our clients are making outside of the portfolio is really taxes. At the ultra high net worth level, you're talking about individuals, family offices that are being taxed at 40 plus. So taxes really do have a huge impact on what they're going to do on a day-to-day basis. So whereas an average investor might say, maybe there's an opportunity to take some profits in a particular investment that might have run up, the ultra high net worth people have to look and say, okay, is this a short-term gain versus a long-term gain? How does that impact the total net proceeds that they get to take home? What are some opportunities that maybe don't make sense on an after-tax basis? And where are some unique opportunities that have popped up as a result of changes to tax law?
All right, to wrap up here, remaining outlook for the rest of 2019, you still expect, or at least into the election, that we're going to continue to see these choppy type of markets?
Yeah, I think it'll be choppy, but at the same time, the yield curve inversion, a lot of people are getting worked up about that. If that ends up being a signal that holds true, I actually think that that's a great tool to use, because what the yield curve inversion has told us is that for the next 18 months, you're going to get anywhere between 18 to 20% returns on equities. The one exception to that over the last 5 yield curve inversions was in 2000, but that equity market sell-off was really caused by the dot-com bubble. So if the yield curve inversion is a real true signal, we've still got 18 months left and probably another 15% to the upside on equities.
All right, Rob, thanks so much for joining us at MarketSite.
Thanks.
All right, and thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.